Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, today we're breaking down a detailed analysis of the U.S. market, specifically from Wednesday, March 18th, 2026. Just so we're clear, this video presents a direct informational narration of the source document.
And of course, we have to start with this. This document is provided solely for informational and research purposes and does not constitute investment advice, a recommendation, solicitation, or an offer to buy or sell any financial instrument. Investing in financial markets involves significant risk, including the potential loss of principal. Prices of equities, indices, derivatives, digital assets, and other financial instruments may fluctuate materially and unpredictably. So here's what we're going to cover. We'll kick things off with the big market pullback and the technicals. Then we'll get into the Fed's, let's call it an unstable path, and what Powell had to say. After that, we'll look at a key inflation warning signal, dig into Micron's wild earnings report, and wrap up with the really critical scenarios playing out in the Strait of Hormuz.
Okay, first up, the market pullback. So picture this. The U.S. stock market was kind of just treading water, and then boom, the bottom just fell out on March 18th. And we're not talking about a little dip here. This was a sharp, deep plunge driven by a major shift in sentiment. So what was the catalyst? A huge geopolitical shock. You had U.S. and Israeli strikes on Iranian energy infrastructure, which led to immediate retaliation. Suddenly, the entire Middle East energy supply was in question. You mix that with a pretty hawkish signal from the Fed, and you've got yourself the perfect storm that sent cautious investors sprinting for the exits.
So let's break down what that sell-off actually looked like. 3 key things to note. First, that energy premium. Brent crude shot up, briefly trading above $110 a barrel. Classic flight to safety, or panic. Second, look at the market's internal health, what we call breadth. It was awful. Only 81 stocks in the S&P 500 were up, while 422 were down. All 11 sectors were in the red. And third, and this is the big one, even the defensive consumer staple stocks got hammered on heavy volume. That's a textbook sign of what we call bull capitulation. That's the point where even the diehard optimists finally give up and sell.
And this chart just paints a really clear picture of that breadth problem I mentioned. I mean, look at those numbers. 81 stocks advancing versus 422 declining. A ratio like that tells you this wasn't about 1 or 2 bad sectors. This was a systemic, market-wide release of risk. So why is that sell-off in consumer staples so important? Well, because those stocks are supposed to be the last safe harbor in a storm. When you see them getting sold off heavily, it's a huge red flag. It tells you that, as the source document puts it, larger pools of capital have entered an indiscriminate de-risking phase. In plain English, big money is selling everything. And that's a telltale marker of that bull capitulation we were just talking about.
Now, from a technical standpoint, the S&P 500 is in a really tough spot. It's pinned right below that big psychological number of 6,600 and also just under its 200-day moving average, which sits at 6,615. Right now, the single biggest variable is what happens with the Strait of Hormuz. If that vital trade artery doesn't get back to normal operations, the market could very well break down through its critical support level around 65.70. Let's put some specific numbers on that for the major ETFs. For SPY, which tracks the S&P 500, that core range we're watching is 653 to 672. For the QQQ, the tech-heavy NASDAQ 100 tracker, the key range is 588 to 613. But honestly, the one to really pay attention to is the ISP. That's the equal weight index. It gives you a much better sense of how the average stock is doing, and its critical band is between 183 and 191. Why does that matter so much? Because many see that as the final red line, the indicator that tells us if this is just a correction or if we're at the beginning of a real bear market. All right, let's shift gears and talk about the Federal Reserve, because their actions really poured some gasoline on this fire. The last FOMC meeting was, well, it was a bit of a mess. Sure, they kept rates on hold, but you can really see the cracks starting to appear. There's clear disagreement inside the committee, and it looks like the Fed is caught between a rock and a hard place. They have an economy that's surprisingly strong, but they also have inflation that just won't go away. This has led to what some are calling a pancake-flipping policy path. They just keep changing their tune. Okay, let's get into the nitty-gritty. The decision was to hold rates at 3.5 to 3.75%, but the vote was split, 11-1. Millen was the one dissenter, arguing for a rate cut. And there were some key changes in the official statement.
For one, they changed their description of the unemployment situation from showing signs of softening to having changed little. And they also added new language about the uncertain economic outlook stemming from the situation in the Middle East. But this is where it gets really interesting. The Fed's own forecasts. They actually revised up their GDP growth projections to 2.4% for 2026 and 2.3% for 2027. But at the exact same time, they also bumped up their inflation forecast to 2.7% for 2026. And maybe the most important change of all, they raised their estimate for the longer-run neutral interest rate from 3.0% to 3.1%. It's a small change, but it speaks volumes. So what's the bottom line here? The Fed has essentially walked itself into a classic policy trap. They're admitting the economy might be overheating by raising their growth forecasts, but they're also being forced to admit inflation is stickier by raising those forecasts too. This is basically them conceding that the whole perfect as inflation story is over. It really cements the idea that we're in a higher for longer interest rate world now. So how did Fed Chair Jerome Powell try to explain all this? Well, if you look at his press conference, even though he's almost at the end of his term, he came out with a very firm, very hawkish message. The signal was unmistakable. The Fed's top priority right now is fighting inflation. Full stop. Even if it means putting economic growth at risk. 3 points from Powell really stood out. First, he drew a very clear red line. He said there will be no rate cuts until they have absolute confirmation that inflation is on a sustainable path back down. Second, he couldn't avoid the elephant in the room, energy prices. He basically said the Fed can't just pretend rising energy costs don't matter forever. And third, and this one was a real shocker, he actually revealed that a small minority within the Fed had discussed hiking rates. That tells you just how seriously they're taking this inflation threat. And on top of all this economic uncertainty, you've got this layer of legal and political risk. There's an ongoing Department of Justice investigation into Powell, and the nomination process for his successor has completely stalled out. All of this is pushing the Fed towards a kind of leadership paralysis. What that means is that after May, the Fed's ability to act might be really constrained by both political wins and legal headaches. As if the Fed's hawkish turn wasn't enough to spook the market, the latest inflation data really sealed the deal. Before the market even opened on Wednesday, we got the Producer Price Index, or PPI, for February. Now remember, PPI measures inflation at the wholesale level, so it's a great leading indicator for what consumers will eventually pay. And the numbers, they were not good. It was a surprise to the upside across the board, which pretty much locked in the day's bearish tone. I mean, just look at this number. Headline PPI was up 0.7% month over month. That's more than double the 0.3% that economists were expecting. A huge miss. And it wasn't just a blip in the headline number. The core PPI, which is arguably more important because it strips out the volatile food and energy components, was also hot. It came in at 3.9% year over year, higher than the 3.7% expected. Now, this is a major problem for companies. When their input costs are rising this fast, they're stuck. They either have to absorb those costs, which kills their profit margins, or they have to pass them on to you, the consumer, which can kill demand. Either way, it's a bad setup for stocks. Okay, let's zoom in now from the macro picture to a single company story that really captures the moment, Micron Technology. Their latest earnings report is just a perfect illustration of the extreme cyclicality, the wild ups and downs that we're seeing in the semiconductor industry. They posted absolutely explosive results, blew away all expectations, and the stock still sold off. Why? Well, it was a mix of profit-taking and just the terrible macro environment we've been talking about. And when I say they blew away expectations, I'm not kidding. Look at these numbers. Their fiscal second quarter earnings per share came in at $12.20. The expectation was for $9.19. Revenue was nearly $24 billion when Wall Street was looking for $20 billion. That's up an incredible 196% year over year. And then their guidance for the next quarter was even crazier. They're forecasting an 81% gross margin and earnings per share of $19.15. Just incredible numbers. So, what's happening here? Well, the pricing environment for memory chips has become so volatile that the traditional valuation models, you can basically throw them out the window. They just don't work anymore. The stock is now trading in what you could call a pure belief in the cycle regime. It's all about investor sentiment and a bet that this super cycle will continue. Technically speaking, the key support zone for the stock is in that $403 to $438 range. Okay, let's bring it all home and circle back to the event that started this whole mess, the situation in the Strait of Hormuz. This is the world's most critical choke point for global energy.
And right now, traffic through it has collapsed to between 2 and 10% of its normal level. And this isn't just about oil prices. It's a major threat to cost stability for any energy-intensive supply chain. Think semiconductors, for example. And this really leaves us with two very different, very stark scenarios. Scenario one, we'll call it reopening. If transit can get back to normal within, say, 2 months, you could see Brent crude oil pull all the way back to the $70 to $76 range, and that would cause inflation fears to cool off really fast. But then there's scenario two, deterioration. If this turns into a persistent blockade, you could see Brent spike towards $150 a barrel, and at that point, you're looking at a real risk of a structural breakdown in global supply chains.
We will conclude with the full professional risk disclosure. This document is provided solely for informational and research purposes and does not constitute investment advice, financial advice, trading advice, or any recommendation, solicitation, or offer to buy or sell any security or financial instrument. The author is not acting as a registered investment advisor, broker-dealer, financial planner, or fiduciary. No advisory or client relationship is created by the publication or use of this document. Investing and trading in financial markets involves substantial risk. Any investment or trading decision made based on this document is undertaken solely at the reader's own discretion and risk. Past performance and historical analysis are not indicative of future results.